Good day, everyone. Thanks for joining us on the call. We'll just unpack the recent results on the third quarter for MTN. Overall, I think it was a good set of results. Over the last 20 months, they had announced the asset realization program, and the idea was to strengthen the balance sheet, extract cost savings, and continue to accelerate the organic growth. This is another quarter of strong execution, and we're seeing that operational momentum continuing. So results came in line with management's guidance of mid-teen service revenue in this period. So we see how that came through. Really, data and fintech driving the growth. Balance sheet is getting stronger. So they're restructuring the hard currency debt and pushing it towards more local debt. And also they're paying down the absolute debt level. So balance sheet becoming quite stronger. No changes in outlook, with only Nigeria committing to a margin which is currently higher than these levels we're at. It was already strong margin, so it was quite a positive going forward. And in terms of our recommendation, we still maintain a buy, and we see an intrinsic value of $197 with about 46% upside. So it's a slight decline from what we had initially. And that just talks about us reducing our multiple midst of the growing concern in just terms of the macro conditions. But the company itself has been really resilient, pushing up a free cash flow, and as the 3 points highlighted above as well. In terms of the event, as mentioned, it was a third quarter results. Came in line with what management was expecting, slightly ahead of what sell side is expecting. The main driver behind the results was definitely data, up about 33% in this period, and fintech up about 13% in this period as well. So we look at the subscriber numbers first. You can see subscriber numbers in this quarter was up 6.8%, which was quite good. Mainly Nigeria being the driving factor, and South Africa, which is a bit of a positive surprise. Service revenue was also strong in this period, up 14%. Growth really, as you've seen in the report, good across Opcos as well. And you had EBITDA margins slightly improving this period, so, from 45 to 45.3%. But in short is that the extracted cost savings in this period of roughly 2.8 billion, which was quite significant, which helped protect margins in the very turbulent times. When looking at the various Opcos, Nigeria was strong, and they're committing in a further increase in the margin. So currently at 53.6, they're looking at a band of between 53 up to all the way to 55, something they didn't have before. South Africa's troubled by load shedding and energy cost increasing, but they were able to protect the margins in South Africa, and they just highlight that it all has to do with the telco agreements that they have on their tower agreements that they have. Ghana strong in this period, up 4%, Uganda slightly flat, and Rwanda slightly weak as well. But overall, it was quite resilient.
Thank you very much for joining us today.